So data quality, as I've mentioned, has cropped up a lot. So overwhelmingly, whenever we speak to people, people say there is a problem with data quality. There is no use developing an incredible tool that assesses things really well. It helps us identify risk. It's great. It visualizes loads, because it's the old garbage in, garbage out concept. If you start with a load of rubbish data, it doesn't matter how fancy your model is, how good your tool is, your output's not going to help you identify risk or collect evidence. So in the UK, a lot of people talk about a common data model, which is something we've been thinking about, talking about with stakeholders. What would a common data model look like? Would it be something similar to the AICPA's common data model? There are other EU-based models. So there's an awful lot going on in that data quality space. It's challenging, but again, it's very important because the data quality is the backbone of all of these kinds of tools and techniques. Without good quality data, we're not going to get to anywhere very sensible. So one thing we've been talking about with audit firms is then, well, what are we expecting them to write down an audit file about data quality? And that's an ongoing conversation, but it's something that we're really trying to get to the bottom of. What's a reasonable expectation when it comes to writing down, well, this is how I was happy with my data being complete. This is how I was happy with the data being reasonably accurate. Something we talked about today was ESG data. As ESG becomes a much bigger topic and the assurance of that information becomes a bigger and bigger question, it kind of compounds to a certain degree the data quality issue though, because if you don't have great quality ESG data, although the reporting itself may be good to have out there, again, how usable and how helpful that kind of stuff is, again, only depends on the quality of the data that you put in. So I'm going to skip that slide, because I've been waffling forever. Thinking then about addressing exceptions guidance. So this is some guidance we've got out there. Again, I can provide a link to anybody that would like to have a look at it. This is really indicative of our approach as a regulator. And if you're going to look at one thing that we've done today, I think it would be this. It has a diagram in it as well. It took me a long time to do that diagram. Essentially what it is it is one potential way of auditors thinking about addressing exceptions. As I mentioned before, we saw lots of issues in inspections where people had spent vast amounts of time going through exceptions that have been generated by a data analytics tool, dedicating all that time to that and no time to challenging management or thinking about professional judgment. All those kind of very subjective areas where an auditor's skill that they've developed over the years is arguably way more applicable, way more useful. So how do we help shift that balance between people sitting there going through every single exception to saying, well, can you actually get happy with big groups of those exceptions in one go? Or are they actually not exceptions to start with? Have you just not quite parameterized your tool properly to start with? And if you've not got your parameters in there properly, what's to stop you going back and reparameterizing it afterwards? The answer that most auditors gave us was, we don't think we're allowed to. We think that the ICEs stop us reparameterizing. So what we thought is, well, why don't we do some guidance to say, that is not what the ICEs say. That's not what we think as a regulator. And we think actually you're wasting a massive amount of time. You could be doing something a bit more sensible. So we developed this guidance to really help auditors think about how to address exceptions. And what it does is it was an attempt to be brief. So it's only 8 pages long, 2 of which are diagrams, 1 of which is a glossary, which is staggeringly short for audit documentation. I mean, ISO 315 itself is 100 odd pages long. So to have some 8 pages long where we attempt to explain a complex issue, ironically, it took longer than doing the long way, but there you go, came out there in the end, was to go through and say, look, here is a possible way you could deal with this problem. So this is the diagram, or one of the diagrams. Again, it's available online, so I wouldn't try to read it in loads and loads of detail. But in essence, what it does is it lays out one way, and it is just one way, because you can do it lots of other ways, that an auditor could use a piece of technology, do some data analytics, they've got a problem. So what they need to do is go, well, actually, I need to think about whether I've understood the tool properly in the first instance. So the example that we used here is setting population expectations. So one we saw in real life that we thought was a good example was an auditor who developed an analytic that went through all of revenue, and it said, well, for every credit to revenue, there should be a debit to accounts receivable or cash. We've been paid, or we're going to get paid. They ran that tool, and they got a staggering number of exceptions, tens and tens of thousands of things, where there's a credit to a revenue, but no debit to cash, no debit to accounts receivable. So what the auditors did is they went through every one of them. Someone on the audit file, their timesheet spent 3 weeks going through every single exception, which on a reporting for a FTSE 100 listed company is the entire length of the audit. Actually, what it turned out is they forgot to put in their original parameters. Oh yeah, there might be a debit to the gift card account as well, because that's one way of paying. Just completely forgotten. So what we said is, well, why didn't you, when you realized that, cycle back up, refine your expectation, and say, okay, debit to cash, debit to account receivable, or debit to gift cards. Boom, way shorter list of exceptions that they could sample, stratify, understand the risk, and respond to much more sensibly, save vast amounts of time, and focus where the risk actually is. So that was the model. There's a specific example in that paper as well that talks through that exact example. And this is very indicative of how we as a regulator are approaching technology, which is to say, there is great potential here for quality improvement, for innovation, for efficiency, and to think about things in a slightly different way. And as I say, if you're going to look at one thing from what we looked at here, I would suggest looking at this, because I think it gives a kind of a coherent view of that sort of philosophy when it comes to the use of technology. As I say, available online. We're actually working on an update to it as well, a second example, which is much more complicated, which will hopefully help auditors of some bigger, more complex entities. This is UK-specific guidance, but the International Auditing Assurance Standards Board, the IASB, are currently working on an international version of it. So if you see this diagram, with slightly different words and ever so slightly different green color, you know why.